All right, so we'll get this thing kicked off. For those that don't know me, I'm Larry Pruss, and I'm the managing director of SRM Perspectives, our thought leadership within SRM, and I'm the host of Tech Talks, where it's we talk about the intersection between traditional finance and emerging technologies. Today, we're going to be doing something a little bit different. We're going to be talking about the economy, which I've wanted to do for a while. And the way we'll do this is feel free to interrupt me or put things in the chat if you want. I'm hoping maybe Patty can monitor the chat, and then everyone else, if you're not speaking, just if you wouldn't mind going on mute. And with that, we'll go ahead and get started. So is everyone able to see my screen? This should be the economic update slide.
Yep.
Great. All right, well, again, good day and welcome to the first SRM Tech Talk that we are dedicating to the economy. Why are we doing this? Well, because the economy dramatically impacts the success and failure of banks, credit unions, and emerging fintechs, and of all of our clients. And what I plan on talking about today are the current economic indicators and potential risk to financial institutions. What I won't be doing today is making any predictions. After all, I am not a trained economist, and I'm certainly no Paul Krugman. For those of you who aren't familiar with Paul Krugman, he's famous for saying in 1997 that the internet's impact on the economy has been no greater than the fax machine. In 10 years from now, the phrase information economy will sound silly. So as you can probably guess, I'm no fan of economist predictions, and hence I won't be making any predictions myself. And while I'm no economist, I do try to figure out the economy. I do find it fascinating, constantly trying to put together all the various pieces of the economic puzzle to better understand the impact to our clients, our partners, and even my own finances. So today, what I'm hoping to achieve is a lot of audience participation and feedback on what you're seeing in your local economies, at your credit unions and community banks. It's just as well as your read on what the economic indicators are telling us. Again, I'm not an economist. My read on some of this could certainly could be wrong, but I'll be sharing a bunch of slides today. And with that, a couple of disclosures. So I'll just skip over the confidentiality notice. And just so everyone is clear, I'm not providing any investment advice today. Don't construe this as professional or financial advice. With that, we'll go ahead and get started. So let's start with a very non-committal statement, which is the U.S. economy is reasonably strong. Now, I could have just as easily said the U.S. economy is reasonably weak, but I picked reasonably strong. So why? Well, I'd say because growth in the U.S. economy continues to come in above expectations. This is despite elevated interest rates, weaknesses in other major economies, and a drawdown in excess savings. Real gross domestic product, or GDP, accelerated to an annual rate of 2.8% in the second quarter of 2004, and it was 1.3% in the first quarter of 2024. And the current GDP number is up from last year's second GDP of 2.1. So that's all good news. However, this apparent strength in the economy is not without some weaknesses. Income inequality, internal political and social division, wage stagnation. We're running a fiscal deficit, and we have over $35 trillion in national debt. Interestingly enough, I was just looking at something today. It's about 300 trillion worldwide debt, but in the US it's about 35 trillion. And as we go through my presentation today, we're going to be reviewing all the latest economic indicators, both positive and negative, and we will conclude by highlighting some of the risks to financial institutions. So let's start with the national debt. I mentioned that earlier. The US national debt currently totals about 35 trillion. And the U.S. national debt to GDP ratio is about 123%. Of moderate economies, only Japan and Italy have worse debt to GDP ratios than the U.S. I think Singapore is up there somewhere as well, but they count their debt differently than we do, and they're probably right in doing that, so I didn't include them in that list. The national debt per citizen currently stands at $104,000, and if you are a U.S. taxpayer, that share of the debt is really $268,000. So it's a lot of money, and it's rising at an exponential rate. and is currently increasing by about $1 trillion every 100 days. The cause of this debt has been, there's a lot of reasons, but one, kind of decades of mismanagement and overspending. Again, not getting political, I think this really has been decades of overspending and mismanagement. An aging population with rising healthcare costs and social benefit costs. So as we age and we've got more healthcare issues, making sure we fund Social Security and those sorts of things becomes problematic when you don't have a big tax base. And the third reason, we have a tax system that does not generate enough revenue to cover government spending. What happens with rising debt is it tends to lead to higher interest rates. The Congressional Budget Office expects the U.S. net interest rates to triple over the next decade, reaching $1.2 trillion annually by 2032. Amazingly, we're currently paying more in interest payments than we pay on our national defense budget. This has never been the case before, even going back to 1940. I think it's safe to say that our growing national debt is starting to limit our ability to address the issues and challenges that we have faced as a nation. So now for a brighter economic indicator, this would be gross domestic product. I alluded to that before. It's currently at 2.8% for the second quarter. And while we are currently observing GDP growth of 2.8 for the second quarter, that growth has slowed from 2023. The slowdown in GDP compared to previous quarters also indicates a moderation in economic expansion. Some other components of the second quarter GDP numbers included non-residential investment being revised higher to 4.4% from previous estimates of 3.3%. Residential investment jumped more than initially expected, reaching 16% compared to an earlier estimate of 5.4%. Exports, and I'll talk about exports in a bit, rose faster at 1.6%, up from 1.2%, while imports were revised lower to 6.1%, down from 7.7%. And then consumer spending slowed more than initially anticipated, slowing to 1.5% instead of the previously estimated 2%. Now that was for second quarter. We'll cover the current consumer spending numbers that came out today, and it was at, I believe, 1%. So this continued but slower GDP growth that is happening in the face of at least decreasing inflation rates might indicate that we're beginning to see a soft landing, and that would be a good thing. So GDP includes as one of its components trade, and that could be like net exports. So that's your international trade. And what happens when you have a trade surplus, or when your surplus increases? I'm sorry. Let me back up. GDP includes one of its components net exports, and a trade surplus increases while a trade deficit decreases GDP. So GDP goes up when you've got a trade surplus. When you've got a trade deficit, it generally goes down. Now, there are other components such as consumer spending that contributes largely to GDP, but there is an impact on international trade. So in essence, the way it works, trade surplus countries are lending to other countries so that the latter can finance their deficits, while deficit countries like the US are borrowing from the rest. The U.S. has perennially been running what we call a goods trade deficit, meaning that we're largely borrowing from other countries to finance our debts. And while the U.S. has had a goods trade deficit, we generally have a services trade surplus. So goods and services, right? Goods tends to be a deficit. We tend to export more services trade. It just happens that our goods deficit has been historically larger than our services surplus, hence the net deficit in our goods and services trade. In June, we had a decrease in overall trade deficit, which is good for GDP. Again, a decrease in the deficit as exports of U.S. goods supports the GDP. So I'll pause there, see if there are any questions. So we talked a little bit about balance of trade, talked a little bit about GDP, and just kind of an opening on the economy. Just see if there are any questions, and then we're going to move on to retail sales. All right, moving on to retail sales. Retail sales are an extremely crucial indicator for the overall economic activity of any nation. Someone, if you can go on mute. In the US, private consumption makes up over 60% of our gross domestic product. So think about that. Private consumption makes up more than 60% of GDP. So that's pretty significant. Retail sales reflect the dollar value of merchandise sold within the retail trade by taking a sampling of companies operating in the sector of selling physical end products to consumers. In the US, retail sales report that came out today is released by the Census Bureau, which is part of the Department of Commerce. To compile the retail sales report, the Census Bureau surveys about 5,000 companies of all sizes, from huge retailers like Walmart to independent small family firms. The retail sales report encompasses both fixed point of sale businesses and non-store retailers, such as mail catalogs and vending machines. The current sales report, we saw a rise of 1% over the previous month, was higher than market expectations by about 2x. This increase was driven mostly by new and used auto sales, in which we've seen prices decrease, and that was a significant component to the slowing inflation seen in the most recent CPI report, and we'll talk about that in a bit. Also adding credibility to the sales report is recent comments from Walmart that said U.S. consumer spending is steadily increasing, and it's since raised its sales forecast for the full year. Now, before taking the retail number at face value, it's worth considering that for 8 months of last year, the previous month's data was revised lower. So they revised 8 months of previous year. So, will this one get revised lower? Hard to say. Additionally, retail sales aren't adjusted for inflation. This is part of the reason that line is pretty much up and to the right? Because as things inflate, or the value of the dollar decreases, you're going to see increasing prices in addition to just kind of normal increasing U.S. sales. The retail sales report mainly captures spending on goods rather than services, such as travel, housing, and utilities, offering only a partial picture of spending. Improving and growing retail sales does suggest the economy is not yet in a recession, so that was a good indicator for today. Increased consumer demand represented by sales could push inflation higher if retail sales are not, if retail supplies are not increasing. So we can talk a little bit maybe about the ISM report later, but if we don't see corresponding increase in supplies and you've got an increase in sales representing consumer demand, you could drive some higher inflation. But I'm guessing probably not. But anyway, speaking of inflation, as a result of pandemic stimulus spending and strong demand supply chain disruptions, which we all experienced during the pandemic, we saw inflation accelerate starting around the second quarter of 2021, and it reached a 40-year high with CPI peaking at 9.1% in June of 2022. Since then, inflation has decelerated. Core CPI, which is Consumer Price Index, is currently 3.2%, down from 3.3% last month, so it's going in the right direction, and it's the lowest since April 2021. The core PCE, which is Personal Consumption Expenditures Price Index, is currently at 2.5%, and the all-item CPI index was at 2.9 for the 12 months ending July. The big driver in CPI reduction was goods prices, which are actually down 1.9% year over year, in which was mentioned this being driven by new and used cars prices falling, which I mentioned before was a big component of the improvement in retail sales. So we're starting to see car prices falling, largely because people weren't buying them, so dealers have started dropping price, and that drove additional retail sales, and then again brought down CPI because they're low prices. This is all good news on the inflation front, and we are inching closer to the Fed's PCE preferred rate of 2.5%. So I'll pause there for a second on inflation, see if anyone feels differently about kind of the numbers, or we may feel differently locally because everyone experiences kind of different price fluctuations. For me, I feel like I'm still spending an awful lot on food, but at least these indicators seem to suggest that inflation is abating a bit.
When you were researching, did you also see how long rates would have to stay low to kind of rejoin the sort of total price index curve?
Yeah, I don't know that. I mean, the Fed's talking about, or it's expected the Fed's going to do an interest rate reduction in September. It could take a while um, for. I mean, inflation is already coming down. So, as it relates to things that we're seeing in like that grocery store, it just could take a while. I mean, these metrics are kind of a combination of a lot of different measurements. So how long it takes to kind of return to normal, or is there a new normal? It could be that grocery store or items stay high, but something else drops, and then on average, CPI stays at 2.5%. And if the Fed feels comfortable enough that they can, loosen the reins a little bit in lower rates, which of course could have the impact of rising prices again. But yeah, I don't know what would drive some of those down other than just supply and demand considerations. Be
Sure,
interested
sure.
if anyone else thought differently.
I just think that sometimes when we talk about things, and you kind of alluded to it, but even to take it a step further, some things that might say prices are going down, it's a generalized statement, because I know like the prices of eggs are still skyrocketing. And so I think that I'm sure, some report that drills down into what components of a grocery store would be higher or lower, and not as sweeping groceries are lower, because I don't think anyone feels that.
Well, and a lot of it's, I mean, like I know some of us are fans of Bitcoin, and Bitcoin is a pure supply and demand type of situation. But the other thing to think about, like with Bitcoin or anything, it's also a reflection of the strength of the dollar. So Bitcoin, if it's priced in US dollars, could go up and down just based on the value of dollars going up and down, in addition to supply and demand considerations. Now with Bitcoin, supply is fairly limited, but demand kind of goes up and down. So yeah, there can be a lot of drivers for any individual good or basket of goods.
So what does all this mean for our banks and credit unions? How do we make the connection to this is low and this, therefore you'll see this?
Yeah, I'm going to get to that. I mean, a lot of that interest rates drive kind of, what banks invest in, and what kind of duration instruments, and some of the problems with some of the mismatch in durations that pose risks. Generally, lower interest rates are better for banks than higher interest rates. I think that's in credit unions. I think that's safe to say. But there's a lot that goes into kind of treasury and impact on loans and loan pricing. Even mortgages. Mortgages don't necessarily directly follow, the Fed fund rate either, right? So a lot of that has to do with like 10-year treasuries and stuff like that. So let's talk about interest rates, since we started to already talk a little bit about that. So as a result of post-pandemic inflation that we just talked about, and as we're all keenly aware, the Federal Reserve, as a result of that inflation, raised interest rates, which made borrowing more expensive for consumers and businesses. And obviously, that's one way that the interest rates impact banks and credit unions, because it makes it more expensive for consumers and businesses. In March of 2022, the Fed made its first interest rate increase since 2018, right? This was a result of the pandemic, raising rates from 0% to 0.25% to a level of 25 to 50 basis points. We observed inflation peak at 9.1% in June of 2022. Then in July 2023, the Fed made its final 25 basis points increase, bringing the rates in at 5.25 to 5.5%. And the Fed funds rate really has not been cut and really hasn't moved since then. At the recent July 31st FOMC meeting, which is the Federal Open Market Committee meeting, the Federal Reserve signaled an openness to cutting rates in September. We observed a subsequent sell-off in the equity markets triggered by weak U.S. data. This led to fixed income traders into pricing the Fed easing rates around 225 to 250 basis points over the next 2 years. It's probably worth mentioning that the market's expectation, at least last year, was to see 6 interest rate reductions. We didn't see any last year. So the market often gets future interest rate adjustments wrong, and Fed signaling is very different than Fed doing a rate cut. So they're two dramatically different things. So whether or not we get a rate cut in September, we'll see. I think the odds are pretty high, and I think the market's putting it about 90%. There's a really great article by the CME about Fed rate cut cycles, which I'll put in the chat here. Just give me a second. Switch over to the. I can manage to do that. Throw it in the chat. All right. There's an article for you guys, gals. Okay, so moving from inflation rates to unemployment. So likely due to the Fed tightening rates, which we've seen since the pandemic, we've started to see some indications of a slowdown in the economy. Unemployment, while still near historic lows, has been steadily increasing since January of this year. The unemployment rate rose to 4.3% in July, and while 4.3% is near historic lows, it's still higher than the 3.5% levels observed before the pandemic. Private sector employment increased by 222,000 jobs in July. Annual pay was up 4.4% year over year, according to the July ADP National Employment Report. And employment has continued to trend up in certain sectors, such as healthcare, construction, and transportation warehousing. However, the information sector, which really was kind of like fintechs, and a lot of that was in California, that sector lost jobs, largely due to big layoffs in tech. And again, in California, in fact, California has nearly lost all of the tech jobs that it gained during the pandemic boom that was fueled by online work and shopping. Some of this layoff also might be due to AI-related efficiencies, particularly around coding, but that's really not the conversation we're having today. Possibly related to some of this unemployment, and I talked about it earlier, is the ISM, which is the Institute for Supply Chain Management or Supply Management. That manufacturing PMI registered 46.8% last month, indicating an industry economic activity contracted at a faster rate when compared to June's figure of 48.5%. So economic industry activity does appear to be contracting, and only 5 out of the 16 manufacturing industries reported growth last month. So supply of goods and services might actually be decreasing, even if there's still an increase in sales. And again, that could impact inflation. It also just might mean that we're seeing a slowing economy. So the increase in unemployment, slowing sales, the decrease in manufacturing, at a minimum, should help support the argument for the Fed to reduce rates in September. According to CME FedWatch tool, the chances of an interest rate cut at the Fed's meeting in September currently stands at more than 90%. So talk a little bit about income, outlays, and savings. Recent numbers from the Bureau for Economic Analysis indicates that for May, personal disposable incomes increased 2.5%, while personal outlays increased 1.5%, and personal savings was relatively flat at 3.9 in May and 3.6 in June. In the U.S., there is evidence of long-term wage stagflation, stagnation. Stagflation is really bad. A long-term wage stagnation, especially when using 1970s as a starting point. The picture is more positive when looking at the past 3 decades. However, recent trends show a slowdown in wage growth, and many experts argue that wage growth has not kept pace with productivity increases, inflation, or has been evenly distributed across income levels. Now we're going to look at housing. So for some time, we've had a housing shortage. This is a result of too few homes being built, high mortgage rates making moving unaffordable for homeowners, COVID-19 disruptions, and Wall Street investors buying up too many owner-occupied homes for rental. Fortunately, we're starting to see inventory increase. Inventory is up 35% from a seasonal bottom in January. Additional good news is that the U.S. Mortgage Banking Association mortgage applications for the week ending August 9th was up 16.8% versus 6.9% for the prior week. The big jump in that past week comes as we see a spike in refinancing activity that comes as the average rate of most U.S. home loans continued falling in the last 2 weeks amid a recent decrease in yields. So perhaps this is good news for the economy. It'll be interesting to see what happens to long-term rates when the Fed eventually does lower their Fed funds. What will be the resulting impact to mortgage rates? Right now, the affordability factor of mortgages has played a huge role in locking up both supply and demand in housing. Once those mortgage rates go 50 to 100 basis points lower, we could see a real opening in a wild west of the housing market, and that would be good for financial institutions. I'll pause here and see if we had any questions on the couple slides leading up to housing here. All right, so overall, while the economy is relatively strong, recent trends in debt and delinquency rates seem to suggest that the economy is slowing. Again, a couple other indicators suggest that as well, which should help with the expected cut to the Fed funds rate in September. Household debt continues to climb and stands at roughly $18 trillion, and that's outside of student loans, which has gotten some temporary relief from the Biden administration. Outside of student loans, which has gotten some temporary relief from the Biden administration. Now, the student loans are included in that 18 trillion of household debt, but those student loans, they've got kind of temporary relief, so they're not seeing a lot of delinquency. But all the other delinquency on that household debt, we're starting to see steadily rise. U.S. consumers also accumulated debt at a slower rate in the second quarter, with net revolving balances falling $1.7 billion in June, which is the largest drop since the pandemic in 2020-2021 period, where people used government stimulus checks to pay down their card balances. Yet the amount of credit card holders falling behind on their bills hit levels not seen in more than a decade. According to the Federal Reserve Bank of New York's quarterly report on household debt and credit, as of August 6th, so that's just recent, credit card 90-day plus delinquencies are 7.18% of total balances. Last quarter's credit card 90-day delinquency rate was 10.9%, and the highest it's ever been since the first quarter of 2012. Auto loan delinquencies are also up. 90-day delinquencies hit 4.43%, the highest level since first quarter 2021. Historically high consumer debt levels, slowing debt accumulation, high interest rates, and rising delinquency rates might indicate that people have exhausted their credit limits and suggest some coming headwinds for the economy. This is why I would be interested from our attendees if they're seeing similar sort of trends at their financial institutions. You don't have to call out the exact numbers, but the trend I'm most interested in is the fact that delinquency rates are rising, but debt accumulation is slowing, which would lead me to believe that people are starting to reach their credit limits and are being forced to kind of pare back on their spending. Any comments from the participants? I'm going to take that as a no and assume that you're seeing similar. So to summarize the past slides, and then we're going to talk about kind of risk to financial institutions and what does this mean. I'd say generally growth is positive, retail sales are up, inflation is moderating, employment is slow but increasing. Housing levels are up, and the Fed is likely to lower rates in September. Actually, I should have said employment is slow, but the unemployment rate is increasing a little bit. Some clouds on the horizon would include a high, growing, and unsustainable national debt level, high but slowing consumer debt, increasing consumer delinquencies, low long-term wage stagflation, and high interest rates that continue to restrict the economy. We'll move into the next section, which is to kind of discuss some risk to financial institutions. So given the state of the economy, there are a few key risks that persist to financial institutions. Two of these that I'm going to cover, kind of actually three, but are related to the economy. And then one's related to technology. I just wanted to cover it. So we're going to talk about concentration risk. We're going to talk about interest rate and liquidity risk. That's kind of one and the same, or at least they're kind of related. And then cybersecurity risks. So concentration risk, there continues to be a potential for significant losses due to exposure to residential and commercial mortgage loans, which could deepen or could lead to significant loan losses, earnings deterioration, capital depletion, and increased failures. In particular, the commercial real estate sector, CRE sector, has been under intense pressure, at least globally, as interest rates have risen over the past couple of years. Bank thrifts and credit unions own nearly 39% of CRE debt. In the US, with the largest commercial property market in the world, CRE prices have tumbled 11% since the Federal Reserve started raising their interest rates in March of 2024. That erased the gains of the preceding 2 years in CRE prices. These challenges are particularly daunting as high volumes of refinancing are coming due. An estimated 1.2 trillion of commercial real estate debt in the United States is maturing over the next 2 years. Around 25% of that is loans to office and retail segments, most of which is held by banks and commercial mortgage-backed securities. But the challenge is that we can see financial institutions start to take losses on CRE holdings. And in fact, several banks have already done that or in a precarious position. Those would include New York Community Bank Corp, Valley National Bank Corp. Both those have CREs that represent greater than 50% of their total loan book. So that's pretty significant. And obviously, a lot of banks and credit unions didn't get into CRE, but to the extent that you have some of that concentration risk, that could be an issue. So I'll pause and see if there are any questions around concentration risk or any comments that anyone has. Okay, well then, if not, we'll talk next about interest rate and liquidity risk. The Federal Reserve's efforts to control inflation have led to obviously rising interest rates, which has negatively impacted the value of bank assets. Most bank and credit union liabilities are largely in the form of demand deposits, and as such, these liabilities tend to be short-term and less sensitive to interest rate movements. However, many financial institutions' assets, not liabilities, right? Assets take the form of long-term bonds, such as U.S. Treasury securities and mortgage-backed securities. These assets tend to have a much longer maturity date, any duration mismatch in taking cash via short-term demand deposits and then investing these funds in longer-term financial instruments can lead to significant interest rate and liquidity risk exposure, as we saw with Silicon Bank's failure last year. Some additional considerations around U.S. Treasury securities, of which financial institutions often invest in, include we now have a U.S. Treasury market that is probably more fragile than in prior decades, with algorithms making up 60 to 80% of trading depth. These algorithms tend to turn off during high volatility periods, potentially exacerbating liquidity issues during market stress. Additionally, stresses in emerging markets, particularly China's property sector issues, could spill over to global asset markets and economic activity, potentially affecting liquidity conditions here in the U.S. It's important to note that while these factors contribute to liquidity concerns, the financial system has implemented several measures to mitigate the risks of severe liquidity crisis. This includes the creation of standing repo facilities by the Federal Reserve. I think that happened after the 2008 crisis, and changes to market structure allows for more diverse participation in the Treasury market. I'll pause here, see if anyone wants to add. I'm not an expert on liquidity or interest rate risk, but obviously it does impact banks and credit unions fairly significantly in terms of their liabilities that they have versus the assets that they hold. Any thoughts or questions on this one? No, are y'all still with me?
Yep, still here.
Okay, that's good. All right, so the last one is not necessarily related to the economy, but more related to some new technology we're seeing. So that threat I want to call out is cybersecurity threats. This is probably really timely given I just read something about, was it yesterday or today? It's suspected that hackers now have access to everybody's social security number in the United States. So Thank you, government, for doing a fine job of securing those security numbers. Okay, well, off my soapbox there. While cybersecurity threats are not new, the tools that criminals are using, like AI, are new. So a couple considerations. All types of cybersecurity threat actors, so whether that's state actors or non-state, skilled versus less skilled, are already using AI to varying degrees. AI provides capability uplift in reconnaissance and social engineering, almost certainly making both more effective, efficient, and harder to detect. AI will most certainly make cyber attacks more impactful because threat actors will be able to analyze and infiltrate data faster and more efficiently, and also use it to train AI models. AI lowers the barrier to entry for novice cyber criminals, hackers for hire, and hacktivists to carry out effective access and information gathering operations. This enhanced access will likely contribute to global ransomware threat over the next few years. And then moving into 2025 and beyond, commoditization of AI-enabled capabilities in criminal and commercial markets will most certainly make improved capability available to cybercrime and state actors. So again, just a third risk that financial institutions have to worry about. Again, not related to the economy, but the prior ones certainly were. And so, kind of in conclusion, then we'll have some discussion. While the U.S. economy remains relatively healthy, at least based on the current economic stats, again, U.S. deficit withstanding, the banking sector continues to experience significant risk. So credit unions, community banks continue to experience risk. Having an interest rate reduction certainly would help. Those risks include concentration, interest, liquidity, and cybersecurity threats. With that, I'll pause, take a drink of water, and we'll turn it back to the group and see if there are any questions.
Going back to the residential housing slide and the increase in single family homes, um, as far as like the addressing the affordable housing problem, do you think that indicator is just suggesting that it's getting worse, like that we don't really have proper fixes coming down the pipe if single family home proportion is increasing? Or does it indicate something else?
Unless the supply dramatically increases, and that would require builders to want to get into that, which would require, they would have to see increased demand for houses, which is being held up by high mortgage rates. So it's kind of a chicken egg scenario. Builders aren't going to build a whole bunch of new homes until they're pretty sure that floodgate is open. So once those new homes start to get built and we have more supply, then prices should start to drop. Even with rentals, I think we've seen like people who are renting have to move to even lower rental, like kind of lower quality rental units, because one is they're just the higher quality ones aren't affordable and they're not available. It is a huge problem in this country. I know other countries. I've got a place in Canada, in Montreal. One of the things they've done there, as well as I think all the Canadian cities, is they put a prohibition on foreign investment into real estate. So if you're a foreigner, you can't invest or buy real estate because it's been increasing the price such that locals can't afford those prices anymore. We could see maybe something in either whoever has this next administration, if they wanted to get serious about housing, what they might do is prevent some of those Wall Street investors, the BlackRocks and others that are buying up owner-occupied homes for rental because they are good investments. If you put a prohibition on that, that again would increase the supply of housing out there. But I don't know there's an easy fix. I'm not an expert at housing by any stretch, but those are just some of my thoughts off the top of my head, Connor.
Gotcha. Thank you.
How about other thoughts, questions? Any other slides anyone wants me to go back to? Well, I ended 10 minutes early. That's a new record for me. Let me go ahead and pause that and then just see if anyone wants to address anything else. trying to expand my window. I'm having difficulty seeing everyone. Connor, is there any question? How about in let me see. I'm just checking
The
to see if there's
chat,
anything in the chat.
just
Yeah.
folks saying thank you.
Okay. Good. Well, hopefully people found this useful. It was fun kind of collecting all this data and pulling together the pieces. It helped me at least have a better understanding where the economy is going. We get different pundits out there that say it's great or say it's bad. It seems like it's kind of middle of the road, at least for me. And it'll be interesting to see what the markets do. The economy does really depend on consumer spending and feeling good about the economy. And some of that we feel in our pocketbook. Some of that is dictated to us through whatever media platforms we follow. But the reality is it doesn't appear that it's terrible. So that's got implications for the coming election. It's certainly got implications for future growth. I hope the economy can remain strong for the benefit of all of our bank and credit union clients. And certainly, I think we are all looking forward to the Federal Reserve hopefully lowering interest rates and giving everyone a little bit of breathing room on whether or not you have debt that's costing you a lot to service, or you want to get a new mortgage, or banks want to see more loans being made. But appreciate everyone's attendance today. Feel free to follow up if this is something that your board would benefit from. I'm happy to do board presentations on these things as well. Obviously, these numbers change very quickly, so it's one of those things I have to have a little bit of heads up if I'm going to do something like that, because it does take a little while to pull all the economic numbers together. But thank you all for your participation, and with that, we'll end today's Tech Talk.